Good morning, good afternoon, good evening, no matter where you are in the world. This is Howie, and I'm here to help you win with money. In today's episode of Back to School, this is level 101. I'm going to talk about why earnings matter, and I'm going to show you a really simple diagram, and then we'll show you that real quick. So let's get right into it. So the first thing I'm going to do is show you a lot of data. I'm going to show you the last 15 years of earnings from two different companies that you may have heard of. The first one is Coca-Cola on top. The second one is 3M on the bottom. And one thing I want to do is let's just scroll back to 2005. What I want to show you is this yellow highlighted line is the earnings per share. Even without knowing what it means, you can see how these numbers are getting bigger. Real quickly, I'm just going to do a quick explanation. Earnings per share is how much profit you made divided by the number of outstanding shares for that year. In a simple case is let's just say they made for every share that Coca-Cola had outstanding, each share had a profit of $1.09. For every share 3M had outstanding, it made $4.12 per share. Now, why does that matter? The per share just makes it a little bit easier to compare. Let's just look at this number, and then relatively to this number, this is the future forecast. They expect Coca-Cola to be making $3.05 per share. If you look at the math, it doubled right here, and it's going to triple over here. On 3M, if you start at $4, doubling is where? Right around 2016. So it took longer to double, and then tripling it's right around here. So roughly about the same time frame. So why does this all matter? I'm going to show you. If you look at this chart, I just used Yahoo Finance. I compared it. The blue one is going to be 3M. The red one is going to be Coca-Cola. And remember what we said? Coca-Cola is experiencing higher growth from 2005 to about 2013. And 3M is actually lagging that growth. So let's take a look at that. And you can see Coca-Cola in red up to 2013. And you see that? It outperformed 3M. Now, look what happens next. 3M sort of goes on this really nice run, but Coca-Cola is lagging behind. But let's look at the data to see why. And as we said, in 2013, Coca-Cola peaked at $2.08 for the earnings. And if you look at this, it basically retouches that point in 2018. And even now, it's having a hard time resuming growth. But in this case, in 3M's case, earnings are consistently growing until 2019. So we're going to take a look at 19 where it's down, and then 2020 is down. So let's take a quick look at that. And you can see from here to here, it grew, and then look, right around 2018 and 19, it went down. Exactly what you would think would happen based on the actual earnings. And if you see these projections, if we're now in 2021 and if it's $9 earning, you can see that the shares are going to move up based on this projection. And same thing with Coca-Cola. If we're at 215 right now, the shares are expected to move up because of this forecasted earnings per share. You can see how historical data has a sort of indirect or direct correlation with the share price. Now, does this always work? And the answer is no. And in some cases, the most classic example is like Amazon. Amazon didn't have any earnings for many years, 14, 15, maybe even 18 years when the company first went IPO'd. They basically spent every dollar they made, reinvested it back into the company. So does it always work? No, but this is a very standard value metrics that people use for sort of more traditional companies. But high growth companies sometimes do bend the rules. They use again a little bit different strategy. But these are good to learn so you can understand how share price can follow whether or not your business is growing or not growing. So that's really the key. And this is just one component of it. There are other reasons why you want to look at this. The dividends continually grew and it paid more and more and more. You can see that even in 3M's case, the dividend is always growing. So as a investor, sometimes you can make enough money just in the dividends because you can see how it paid out 56 cents per share, and 15 years, 20 years later, now you're nearly 3.5, almost 4 times your money. Same thing here. If you start at $1.50, you're already 4 times your money if you make it down here. In any case, I want to keep this video short. Let me know what you think. I want to do more of these more simplistic, easy to understand videos so that you guys can learn some basics of how and why stock move in a certain direction based on how well the company is doing. Don't forget, let's do this together. Let's do this $1 at a time. As always, have a profitable day. Bye-bye.